Hi there. How's it going? Thank you for joining me again. Today, I wanted to cover the topic of mortgage insurance. Really, what is it? How is it used? How do you pay it? How long does it last? And then, lastly, is it worth it? Is that something that we want to use? And I'll start off by saying when I mention mortgage insurance, most people are a little taken back. It's not something that everybody's really excited or comfortable with. But we're seeing it being used more and more, especially with the price of real estate increasing. So, what is mortgage insurance? Mortgage insurance is an insurance policy that's going to be paid for by you, the borrower or the buyer. Um, and it really just allows you to put less down payment. A conventional loan is going to ask for 20% down. Now, for example, in our Honolulu market, October 2018 median single family sales price for a home is $795,000. Let's just say 800,000. 20% down payment is going to be $160,000. That's a pretty good sized chunk of change that I think not a lot of people will have readily available. On top of that, there's some closing costs as well. So what do we do in that situation? Uh, Take a look at mortgage insurance. It For a first-time home buyer, it'll let you go down to 3% down payment, and for a primary purchase, down to 5%, um, or putting a 5% down payment. So it's kind of nice. Something you want to consider, and there is a balance that you can see, and it can be financially beneficial, um, to you to stay a little more liquid. So how do you pay mortgage insurance? You can pay it in three ways. First is a monthly premium, just add it a part of your monthly payment, and we'll collect that and pay that as part of your mortgage payment. Um, or you can pay one lump sum at closing, and lastly, a combination of the two. Maybe you pay partial lump sum, but just to bring down that monthly payment to make it a little more manageable. That's kind of nice. The next thing that people often ask is how long does it last? Uh, Mortgage insurance is meant to insure the mortgage until it kind of gets below that conventional area where it is 80%. So once you get below 80% of your home's value, let's say you do go 5% down, you're at 95, you're paying. Now you're at 80% here. You call in, Shane, I'm below 80%. Um, let's take the mortgage insurance off. Okay, we call and we take it off. So the monthly payment just wipes out from there. If you don't call, it automatically will come off at 78%. So it's not something that you have to necessarily jot down, but it is to your benefit to do that. Um, and lastly, is it worth it? Okay, so just a real quick, I got the whiteboard. I wanted just to start off again that median sales price for a single family home in Hawaii, roughly $800,000. Now, if again, just for illustration purposes, if we were to ask for 20% down, which is our conventional area, um, that's $160,000. Now, let's say we have $100,000, but we make enough money to purchase or qualify for a loan that would allow us to buy this. What do? Well, we say, hey, why don't we look at putting 10% down, right, at this 90% LTV or loan to value, and the mortgage insurance kind of covers this added part, and it allows you to put only a 10% down payment. In that case, you're only putting down $80,000 as opposed to the $160,000. Um, so that's a big saving. So you might be paying to have that insurance premium, but it's also going to keep you from shelling out $80,000. Some good stuff. Again, I wanted to cover that first-time home buyers mortgage insurance will allow you to go to as low as 3% down, and if it's it's not your first time, but it is your primary residence, mortgage insurance can allow you to go as low as 5% down. If you want to look at some quotes or you want to get a little more specific on what that cost is, please give me a call, email, and I'll be happy to check some pricing out online and get that over to you. Anyway, that's a real quick wrap on mortgage insurance. Thank you again for joining me, and have a great day. Thanks.